So we're going to start a new topic today. And before we start the new topic, I want us to recap a little bit of what we have done so far. So far, I have treated with you tax avoidance and tax evasion. So the expectation is that when a question comes, no matter how it is put, you'll be able to discuss something. Even if it is 20 marks and you get your 10, 11, 12 marks, you should be able to pass. Again, we have discussed the various forms of business organization and their tax implications. Over here, I ask you to take a critical look at it, more like go beyond what we discussed. The reason is that some laws have been passed in between. If you look at the material I shared with you, and especially the past questions, some laws have been passed in between. And so personal income tax rate has been revised today. If you earn 50,000 Ghana cedis, you pay the highest rate of 35%. And so if you look at the old past questions and you try to use it to answer those questions, you'll get it wrong. For example, previously, the highest tax rate that an individual could pay was 30%. Now it is 35%, and it is even above 50,000 Ghana cedis. That's when you pay 50,000 Ghana cedis a month and 600,000 a year. That's when you pay the 50,000 Ghana cedis if you are an individual. For a company, apart from you paying your corporate tax of 25%, you are likely to also pay the growth and sustainability levy of 2.5% or 5% or 1%, depending on the sector of the industry. So I ask you to take your time and look at the law, put it together. Please, it is important that you prepare yourself as we go along and we have the revision. You prepare your notes. Don't pile them. Other than that, the time will come when you notice that the thing is too many for you. So once a week meeting should allow you some 1 hour or 30 minutes or whichever time you allocate for your studies. Should be able to put your notes together. And as we talk and have the lectures online, you should also be making some notes. So these are the two topics that we've done so far. Today, we want to look at another one, which is financing a company. Any questions so far? Today we'll be starting tax implications of financing your business, the various sources of finance, and then their tax implications. Any questions so far? Who doesn't follow what we are doing? Who is confused about what we are doing? Do I take it that we are all fine? If we are, somebody should just give us the confirmation, then we'll move on.
Yes, we are fine.
Okay, thank you. All right, so let's take a few minutes. We want to look at a typical past question, either on this avoidance or forms of business organization. This is February 2024, and question 5, he says, with the aid of appropriate authorities, identify 3 forms of business Okay. With the aid of appropriate authorities, identify 3 forms of business organization and the income tax implications of these business vehicles on the after tax returns of an investor. Here we limited you. In your discussion, sometimes you can go beyond the income tax if you think that there's some peculiar thing that you need to mention, but generally the indirect taxes, VAT and all those things appears to apply to majority of them. So we normally want to restrict you to the income tax. And when we say with appropriate authorities, it doesn't necessarily mean you should go and quote cases, but at least you should have the tax law speaking. You should be saying certain things about the tax law. Whatever position that you are taking, is it bad? Can we find it in the tax law? Those are the authorities that we expect you to have put down. Remember that at this level, you are not just writing generally. I admit that sometimes the tax law, you can't put it in your head, but at least from here, immediately the results are released. You are a tax consultant. So some critical provisions, by now you should know them. And again, if you don't read the tax laws continuously, you can't remember them. Imagine you giving me an advice and I can't even find it in the tax law, or maybe you read it in some book. Okay. And when you read it in the book, that particular law has changed. How do I rely on that opinion? You'll be causing trouble for me as your client, honestly. And you know, the way tax laws changes, most authors are unable to update their books. Rather than that, you will lose. Almost every year, new government, as we speak today, we are hearing the major political parties coming and saying that they are going to change the tax system. Then someone has written a book and then stated or explained the position of the law somewhere. Then you go and pick it and start running with it. Meanwhile, a new government comes and they've changed it, and then you are still quoting it as your reference. You're going to cause trouble for your clients. So we expect that at least at your level, having gone through either a lawyer or having gone through either a chartered accountant, and this is your second chartered course, you should be able to have some authorities from the Income Tax Act to back some of the things that you say. Any question on this one? I know some of you will say you can't quote, but you have to at least show some learning. Any question on this particular question, February 2024, that we have read?
Yes. Also, good afternoon.
Yes, madam. How are you?
I hope you are too.
Yes.
Thank God. To discuss the tax implications of establishing it, reference to what we discussed last week, Saturday, I can't quote you verbatim, but you said the conclusion cannot be specific. Like you can't draw a specific conclusion because you have to identify the various pros and cons of each business type. In this case, how do we answer this question? Because every answer
did I make that statement? I don't remember.
I
If
said
I made it.
I said I can't quote you verbatim,
Okay,
but
okay.
that's what I
Yeah,
deduced from what you
yeah,
said. If I'm wrong, I stand to be corrected. Yeah.
yeah. Okay. So last week I mentioned that before I think 2023, the tax implications of a sole proprietor was very clear. Sole proprietors were taxed at, say, 30% maximum. You know, a sole proprietor, you are an individual. Mami, are you with me?
Yeah. Yes.
You are an individual. So the maximum the maximum tax rate, even using the graduated, or even granted that you have all the reliefs, the maximum we could tax you is 30%. Then in 2023, we came up with a new table. And we are saying that the maximum PAYE rate or the individual rate is 35%. At the time when it was 30%, if you put all the tax rates together, even without going into detail, corporate tax was 25%. Then you pay dividends. Dividend tax is also 8%. So the 25 plus 8, it gives you 33%. So
Yes.
a simple comparison will tell you that an individual who is taxed using the graduated rate is better off than a company. Now, we have changed the whole situation. Companies remain 25%. We have also introduced growth and sustainability levy of 2.5%. I'm using 2.5% because that is the one that applies to almost everybody. With the sector specific ones, some of them are doing 5%, others are doing 1% on their revenue. But let's take it that we are even doing the 2.5%. So, Mame, you pay traditionally, you pay your 25%. You come and pay 2.5%. We are just adding the nominal amount, because normally the 25% is on your chargeable income, but the 2.5% is on your profit before tax. So if I take the nominal values, the nominal percentage, 25 plus 2.5, that will give me 27.5, isn't it?
Yes.
Then I come and pay dividend, 8%. This takes me to 35.5%. Do you understand?
Yes.
Okay. It still appears that a sole proprietor or an individual is better off. Is that not the case? Mami, are you with me?
Yes, I'm with you, please.
Good. It still appears that an individual is better off. Now we introduce a partnership, because a partnership is also a form of business. Now, if you look at a partnership, they are also individuals. So, ideally, they will also be graduated. We also use the graduated rate.
Yes.
And therefore, they will behave like an individual, a sole proprietor. But we introduce another concept and say, look, partnership can be a non-resident. And therefore, if it's a non-resident person, his rate will not be the normal graduated rate, but his rate will be the fixed rate of non-resident individuals, which is 25%.
Yes.
So if you do that, then it means that this guy is having a lower rate. So maybe partnership may be better in the case of non-residents. So you need to look at each of them. You need to discuss each of them and draw a conclusion on each. You can't just say straight away, say a company is better off. No.
Okay.
Or you can't just say in the sole proprietor or individual is better off, or a partnership is better off. If he's a resident partner, then he will go for the normal graduated rate. Do you see the point?
Yes.
So you should at all points be able to draw a conclusion, but you need to discuss each and every one. And the example that we're going to look at, we'll look at it from that particular perspective. So, Mame, kindly read for me if you are in a good place. Look at the answer platform.
Okay. With the aid of appropriate authorities, identify 3 forms of business organizations and the income tax implications of these business vehicles on the after-tax returns of an investor. Answer plan. Candidates are expected to discuss the tax implications of establishing a company, a partnership, or a sole proprietorship, and which form of the business organizations gives the least tax exposure for an investor. The discussion should contain the following points. Take the noise downstairs. A company is taxed separately from its shareholders. A company is taxed separately from its shareholders. Section 58, subsection 1 of Act 896. Income derived or expenditure incurred by managers or shareholders, whether jointly or severally on behalf of a company, is regarded as income derived or expenditure income by the company, even if the company lacks legal capacity to derive the income or incur expenditure. That's Section 58, subsection 2 of Act 896. All arrangements between a company and the manager or shareholders of the company are recognized for tax purposes unless the arrangement offends anti-avoidance provisions in the Act, Section 58, subsection 5 of Act 896. Generally, the corporate income is taxable at the rate of 25%. See first schedule to Act 896. Generally, dividends paid by a resident company to a shareholder are subject to withholding taxes at the rate of 8%. Section 59, subsection 1, and first schedule to Act 896. Thus, generally, the total tax exposure on an investment in a company is 33%, that is 25% at the corporate level and 8% at the shareholder level.
Good, Mame. So you see, this is likely to give you 5 marks. But what I'm saying today is that as we speak today, we also have growth and sustainability levy, which applies to almost all companies, isn't it?
Yes.
So you should mention it as well.
Okay.
So if you add it to it,
then it will go up.
correct.
It will move up an extra 2.5 or 5 or 1.
Correct.
Okay. Okay.
So here you are just discussing the way companies are taxed, and your authorities are what we have stated here, that at least you should draw some inspiration from the Income Tax Act, how companies are taxed.
Yeah.
Okay. Go to partnership.
A partnership. A partnership is not liable to pay tax on its income and not entitled to any tax credit with respect to that income, but is liable to tax with respect to final withholding payments. Section 52, subsection 1 of Act 896. The income or loss of the partnership is allocated to the partnership in line with their profit and loss sharing ratio, as stated in the partnership agreement. Section 52, subsection 2 of Act 896. Arrangements between a partnership and its partners are recognized for tax purposes and considered in determining the share of an individual partner, unless stated otherwise in the Act, that's Section 52, subsection 6 of Act 896. The income or loss of the partnership for year of assessment is allocated to the partners as income or loss in their profit or loss sharing ratio. Sections 54, subsection 1 of 896. Taxes paid under the Act and foreign income taxes paid or treated as paid by a partnership is allocated to the partners in their profit and loss sharing ratio and treated as paid by the partners. Section 54, subsection 6 of Act 896. Since the profits are allocated to the partners in their profit or loss sharing ratio, the income of the individual partners will be taxed on a graduated scale, which starts from 0 to 35% if the partners are resident for tax purposes. However, if a partner is non-resident for tax purposes, the income will be taxed at the rate of 25% as provided for in the first schedule to Act 896. Given the fact that Section 133 of Act 896 defines partnership to mean an association of two or more individuals or corporations carrying on business jointly for the purpose of making profit, irrespective of whether the association is recorded in writing, it's possible that the partners could be entities. If the partners are entities, the profit allocated to the partners will be taxed at the corporate tax rate, which is generally 25%, as provided for in the first schedule to Act 896. Hello?
Yes. Let's go to sole proprietorship.
Okay. Well, I have a question on the partnership. So under the partnership, if they are entities and we're going to tax them at 25%, will the GSL also apply here?
It gets into the hands of the company. That one, then you are looking at the second company. But here we are looking at the first entity.
Okay.
Uh-huh.
Okay.
Go to sole proprietorship.
Sole proprietorship. The sole proprietorship is not distinct from its individual owner for purposes of income tax. Income earned by the sole proprietorship is taxed in the hands of the individual. If the owner is resident for tax purposes, the income will be taxed on a graduated scale up to a maximum of 35%. See first Schedule to Act 896. If the owner is non-resident for tax purposes, the income will be taxed at a flat rate of 25%. See first Schedule to Act 896.
Let me ask a question there. Can a sole proprietor be non-resident?
Yes.
How?
If the sole proprietor doesn't fit into the resident is it clause or
The sole proprietor is not in Ghana.
Yes, the 183 days and all of that.
So maybe he has asked his brothers or sisters to operate a business for him,
Yes.
even though he's not in Ghana.
Yes.
Okay. So then it looks like, depending on your resident status, everything can change.
Yes.
Yeah. Okay. Go ahead.
All right. Candidates are expected to further indicate that if a partnership is established by either resident or non-resident entity, the tax rate on the income will be 25%. If a sole proprietorship is owned by a resident individual, the income will be taxed on a graduated scale up to a maximum of 35%. Similarly, if a partnership is owned by a resident individual, the income will be taxed on the graduated scale up to a maximum of 35%. Income earned by a company is generally taxed at the rate of 25%, and dividends distributed to the shareholders is taxed at the rate of 8%, and this brings the total tax exposure of the investment to 33%. So per your explanation, I can add that candidates should add the SGL levy as well. Thus, the effective tax rate of the sole proprietor, the resident status of the partners, and the type of business organization of the partners will be critical in determining whether a sole proprietorship, partnership, or company provides the least tax exposure to an investor.
So you see that you have been able to conclude.
Yes, but maybe I didn't put my question right. This is what I was saying. If I say we can't conclude, this is what I mean. Like, I mean, we couldn't conclude.
You are only saying that you are only saying that depending on the resident status of the person, this is how it's going to be.
So this is what I meant. Like, this is the answer I wanted. That we cannot choose just one. We will conclude on factors to be considered, not on the business type. That's what I mean. Please, should I continue?
Dominic has a hand up.
Oh, okay. Okay.
Yes, sir. Good afternoon.
Good afternoon.
My issue of concern is about saying a non-resident has a favorable tax rate than the resident person. I think it would depend on the income level. Because if the person's income is just a little above the 35% bracket, the average, because it's going to get a 0, a 5%, a 10%, cumulatively, even though you may enter the 35% bracket, if you put it together, the effective rate may still be lower than 25. Because the person, if let's say just about 1,000 is what is entering the highest bracket. But if the person's income that enters the upper band is big, that is where the effective rate will be higher than the 25% for the non-resident. That is my opinion.
You have a point there, and I think you can also include it. You can also include it in a situation where when they make losses, they also not pay any tax. But you see, as a consultant, you are advising someone. Are you going to advise him that to avoid the taxes, therefore don't make enough money? But I agree with you. You have a point. The reason why we don't want to comment on the income level is that you cannot restrict somebody and say to avoid tax and don't make enough money. Dominic, what do you think?
I agree with you.
Mm.
But then that is where tax planning will come in.
Okay.
And then he will share the income with somebody else.
No, that one you are
As
going
partners.
to into income splitting.
Yes.
Then we'll arrest
So
you.
that they will,
Anyway.
all right, sir.
So we want to look at the all right. So today we want to consider another important area. Traditionally, examiners have been focusing on this part, but we've been limiting ourselves to only two sources of finance. I believe everybody on this platform is either a chartered accountant or something. So they know the various sources of financing a business. You can have debt financing, which is mostly the borrowing of funds through either a loan, which your bank has. Can you see my screen, please? So my
Yes.
screen is okay. So either you are borrowing a loan, you are borrowing funds through a loan, you go to your bankers, maybe overdraft. It's also a debt, but that's a short-term debt. Or you want to issue a bond. You pay the money back with interest. What is the tax implications? Okay. The next one is equity. Whether you are raising capital by selling some of your shares to other investors. What is the tax implication if you want to do your business with equity? So most of your exams, most of your questions limit the discussion to debt financing or equity financing. Now, I want us to go further. Is retained earnings also a source of funding? Any views? Akuka is retained earnings. You are an accountant. Akuka is retained earnings a source of funding? Guys, let's talk. Krista.
Yeah, to me, I think it should be.
Okay. Why is retained earnings a funding or a source of finance?
You are taking some of the retained from the business to reinvest in the business.
Okay.
I think it should be.
Okay. So retained earnings is also a source of funding. Any other view?
Yes, it's a source of funding. It's a deferring of the shareholders' dividend that is being reinvested into the business.
So
So it's a source of funding.
okay. Does it come with cost? Does it cost money, or that one is a free money?
It's a free money.
Okay.
Okay, it's just it from the I don't know how it's treated, whether the shareholders will say because you have deferred my money, when you are paying me dividend, you should pay a higher amount, but since it's coming from the same company and the dividend will be paid just as it is, then or it's be added to the shares of the shareholders. I don't think it comes with any cost.
Okay. Here, I want you to, in case you meet it, I want you to look at the tax implications of a retained earnings. Let's look at grants, gifts. Is grants taxable? Grants and incentives, are they taxable? Assuming that government gives you a grant, or let's say you're in Unilever Ghana Limited, then the government gives you some money. Is it taxable? Should it be taxable? We want to look at that one too. Okay. For leasing, is it also a source of funding? Buy or lease. Some accountants will say yes, it's a source of funding. What about sale and lease back? I know most people do that. Most companies who before were owning some assets, they can sell the assets and lease it back. All these are forms of funding. What about trade credits? Trade credit. These are short term, isn't it? Some of these things, they are source of funding, but I won't look at it. Partnerships, if they are contributing capital, venture capital, crowdfunding, raising small amount of money from people, can be personal savings, can also be source of angel investors. These are all sorts of funding that you can use to, fund your business. For tax purposes, I'm going to look at a few of them so that we look at the tax implications for them. If it comes in the exams and you are asked to discuss, depending on the question, for example, let me look at this particular question. February 2024. Krista, are you with me? Can you read it for us? Is Krista online?
Okay. Yes, please.
Okay. Read it for
February
us.
2024. February 2024, question 4. Aramco Petroleum Limited, that is Aramco Saudi, is a petroleum company resident for tax purposes in the Kingdom of Saudi Arabia. Aramco Saudi holds 70% of the shares in Aramco Ghana Limited. That is Aramco Ghana, an oil marketing company incorporated under the laws of Ghana. The stated capital of Aramco Ghana is 8 million Ghana cedis. The directors of Aramco Ghana have informed the shareholders that the company needs to raise 32 million Ghana cedis to expand the operations of the company to increase its market share and profitability. Due to the limited credit options within the financial sector in Ghana, the directors of Aramco Ghana have suggested that the shareholders should provide the 32 million Ghana cedis the company requires. The shareholders of Aramco Ghana are contemplating whether to finance the activities of the company either through debt or equity. Required. Advise the shareholders on I, the tax implications of financing the activities of Aramco Ghana with either a loan or equity. 2, the proportion of the 32 million Ghana cedis which the shareholders can invest by way of equity and debt to make the interest on the debt fully deductible in the books of Aramco Ghana.
Good. So this is a typical financing question, and they need money. For them, they've limited themselves to either debt or equity. So you can apply the Income Tax Act to deal with the debt or equity and answer the question. So, Krista, you see that this question is 20 marks, and we've limited you to either debt or equity. But there's that possibility that we can also ask you to discuss the various sources. So maybe we can give you debt, we can give you equity, we can give you retained earnings, we can give you leasing, we can give you sale and lease back, all of these things. And then we ask you to discuss, or the directors may list this as the options. Then they ask you to discuss which of them they should go. But I think from the question that you read, it's largely debt and equity, and then some, implications of financing it through the 32 million that they've seen. So let's discuss first debt financing. Like we mentioned earlier, debt financing, you are borrowing money from either a bond or from a bank. The first thing that throws up to you is that there is interest deduction, and that is Section 10. You should mention it. That Section 10 allows deduction for the interest that will be paid if the debt is borrowed and used in the production of the income or in the production of the accessible income. Remember that we always want to tie the expenses to the income. So if the debt is not borrowed in the production of the income, either by buying an asset, which ended up producing the income, or you use it in any other case, which resulted in the production of the income. That is why we mentioned the last time that if you borrow money specifically for payment of dividend, it never went into the production of the income. Therefore, Section 10 is not satisfied. Krista, read Section 10 on my screen for me. Let's see.
Okay, so debt financing. 1, interest deduction.
No,
Section 10 allows.
Read the one in italic. Section 10.
Okay.
Interest.
Section 10, interest. For the purpose of Section 9, interest incurred by a person during a year of assessment under a debt obligation of the person is incurred in the production of income to the extent that A, where the debt obligation was incurred in borrowing money, the money is used during the year or was used to acquire an asset that is used during the year in the production of the income. And B, the debt obligation was incurred in the production of income in any other case.
So Section 10 has some strict requirements. Wherever the loan was used, it must be directed towards the production of the income. So, for example, you used to acquire an asset, and that asset was used during that particular year in the production of the income, or you use it in any other way. For example, you use it to buy stock, or you use it to pay salaries, or you use it to something. But at the end of the day, that connectivity between the production of the income and the loan must exist. So the first implications of debt financing is the interest deductibility. You don't end there. You move on to think capitalization, because it is not everything that can be deducted. So under Section 33, which we discussed the last time when we're looking at the anti-avoidance provisions, if the debt to equity ratio exceeds 3:1, especially for persons in control relationship, excluding financial institutions, then the excess interest will not be deducted. It will not be allowed. Section 33 says, where a resident entity, which is not a financial institution and in which 50% or more of the underlying ownership or control is held by an exempt person, either alone or together with an associate, has a debt to equity ratio in excess of 3:1 at any time. Look at that word very well. Any time. It can be a day, 2 days. At any time during a basis period, a deduction is disallowed for any interest paid or foreign currency exchange losses incurred by that entity during that period on that part of the debt which exceeds the 3:1 ratio, being a portion of the interest or loss otherwise deductible but for this subsection. So that's another important thing, another implication that if you're advising your client, you should also mention when it comes to debt financing. Okay. That's not the only thing. Whatever write-up that you'll be giving to me in exams, I'm expecting that you make mention of what? The withholding tax. The interest that will be paid, granted that you have gone ahead and you've done everything. Any interest that you pay must attract withholding tax. and depending on the tax treaty that exists between the two countries, the standard rate is 8%, and that can be found under Section 115. Section 115 says, subject to subsection 2, a resident person shall withhold tax at the rate specified in paragraph 8 of the first schedule, where that person pays any dividend. In other words, if you pay dividend, there must be withholding tax. You take lottery winning, interest. See, I've highlighted the interest. So if you are a resident company in Ghana or resident person in Ghana and you are paying interest to anybody on a loan, then the rate is 8%. Please, I will need you, if you go to the first schedule, I will need you to distinguish this from the payment to an individual or payment by an individual. If you're an individual, you cannot withhold. And also, when the payment is to an individual, the rate is 1%, not 8%. Go to the first schedule and then you see it there. So don't put the two together. Don't state the 8% as the general rate. If you are paying to me, the interest rate is 1%. Okay. Now, 2 says this section does not apply to payment subject to withholding tax under 114 or payment by an individual. So if you are an individual like me, if I go and take a loan from Krista, and I'm paying her, I can't take withholding tax because individuals don't have the power to withhold. If you allow individuals to withhold, that one there, they would arrest us. Okay, they will catch us. And we won't find them. Okay. Won't find them to withhold. And then interest paid to a resident financial institution. Banks, you can also withhold on their interest because it's exempt. You know, their main income is lending. So if you allow borrowers to withhold, at the end of the day, they're not going to get anything left. So if you are paying any interest to a bank or a financial institution, you don't withhold, or a payment that is exempt. Okay. So remember to mention interest when you are discussing debts. Another important thing that you must also mention is the non-deductibility of dividends. See, you are now, hey, where am I? We are still on debt financing, right? Okay. Any question on debt financing? I think I'm done with debt financing. Any question? Then I go to equity. Any question? Can I proceed?
Yes, sir.
Okay. Please look at debt financing.
Sir, can you come again, please?
No, I'm asking whether I can proceed.
And I'm also asking if you could please, since it's very important, if you could please take it again, the explanation.
Which point?
No, the main point, that's debt financing and the implications of financing a business with that type of financing. The implications. You mentioned interest, deductibility, and on that you mentioned think capitalization, because you have to look at the debt equity ratio and everything. But I wanted you to just summarize it small for us.
Okay, so when you are discussing debt financing, talk about interest. Talk about interest by referencing section 10. Talk about think capitalization by referencing section 33. And then talk about the withholding tax on interest. Withholding tax on interest, you can talk about section 115. And the general rate is 8%. If it is payment to individual, then the rate is 1%. So these are the three things you need to look at when you are discussing debt financing.
So please, payment to individuals. I don't understand that portion.
Okay. Go to the first schedule, paragraph 8. Do you have your act there?
Yes, please, I have it.
Okay, go to the first schedule.
Okay. Okay, so paragraph 8.
Are you at paragraph 8?
Yes, please, I'm here. Rates
Good.
of withholding tax.
Good. Read it for me, let me see.
Okay, paragraph 8.1. The rates of tax to be withheld from payment under division 2 of part 8 are
To the B.
A.
Come to the B.
Okay, B. A payment to which section 115 applies.
Mm-hmm.
I.
Section 115 applies. You see that section 115 is what? Withholding from investment returns. Okay.
Okay, yes.
I says what?
I says in the case of dividends, 8%.
Good. Mm-hmm.
And II, in the case of interest paid to individuals, 1%.
Good. So this is the 1% I was talking about. That if I come and borrow money from a company, I am an individual. Okay. Or let's assume that I'm a business. Then you come and borrow money from me. Or you are, who is talking? Godfrey, right?
Yes, please.
So Godfrey Limited is a bank. Godfrey Limited has made me deposit some money, or it came from some money from me. Then Godfrey Limited is supposed to pay me interest on the money you have taken from me. Is that not it? You have to pay me money, isn't it? You have to, let's assume that it's a fixed deposit. You are supposed to pay me interest. Is that not it?
Yes, please.
Good. But I'm an individual. You are supposed to withhold. Is that not the case?
Yes.
When you are withholding from my interest, I've earned income and this interest, you are supposed to withhold. You are a resident person. Now, when you are withholding from me, because I am an individual, the paragraph 8.1b says that in the case of interest paid to an individual, then the rate should be 1%. Do you get a point?
Yes.
Like Men's Good. Men's Good was paying interest on people. Is that not the case?
Yes, please.
Were you part?
No, sir.
So your money didn't go ahead. Okay.
but many friends of mine.
Good. So Men's Good was a company. Men's Good, when paying the interest, should have withheld 1% from the people. Why? Because these are individuals who have invested their money. But if it is a company, if you are paying the interest to a company, let's assume that you are a company and then you have done fixed deposit and the bank is paying you interest. That one is to go for 8%. That is the first one. You understand? Sorry, the II. I. It said in the case of any other interest, 8%.
Okay.
Is that okay?
Yes, please.
So when discussing the implications of debt financing, I need you to mention the interest deductibility. However, it is not a free fall. There's a thin capitalization rule. If you go beyond 3-1, the interest will not be deducted. And in any case, there's a withholding tax of either 1% or 8%, depending on whether you are paying it to an individual or you are paying it to any other person.
A company. Okay.
Not necessarily a company. Even we have a trust. Is in any other case.
Okay.
In any other case or in any other interest. So even if the payment is to a company or whatever, we have to take the percentage. All right. So let's move to, okay. Any other question? Any other question before we move to debt financing? Okay. Let's move to debt financing and equity financing. Sorry. Equity is putting your money into the business in the form of shares, either ordinary shares or preference shares. Your return is what? Dividend. Okay. So when dividend is paid, the first thing is that dividend is not a deductible expense. So you can't deduct dividend, unlike interest, where you can deduct the cost of the money. Cost of the funds in the form of a loan is interest. Cost in the case of equity is dividend, because that's the return they are getting. But dividend is not allowed for deduction. Why? Because under Section 8, it is seen as what? Excluded expenditure. Section 8 of 896. And then Section 134. So Section 130, subsection 4 will define what an excluded expense is. Let's look at Section 8, general principle. Subject to the said schedule, the Commissioner General shall not allow a deduction for the purpose of ascertaining the income of a person from employment. B2 says the Commissioner General shall not allow a deduction in respect of domestic or excluded expenses incurred by a person. So I've underlined the word excluded expenses. Anything which the law says excluded, you cannot deduct it. So let's go to section 130, subsection 4, and look at what is excluded expenses. It says that for the purpose of this act, unless the context otherwise requires, excluded expenses means tax payable under this act. So if you pay income tax, you can't deduct it. That's why tax is not deducted. These things you are doing them in advanced taxation, isn't it? Then B, bribes and expenditure incurred in corrupt practices. This can also be deducted. But let me ask a question. I know we are not doing advanced tax. So bribes and expenditure incurred in corrupt practices will not allow you to deduct. What about income, bribe money received? Will it be taxed? Cresta,
Yes, sir.
bribe money, will it be taxed?
Yes.
Why? Is it a clean money?
I don't think somebody will acknowledge receiving a bribe money
Is it?
or will disclose.
Is it?
I don't think somebody
it
will
will be taxed.
disclose.
But will the person disclose it in the first place?
The fact that he has disclosed the expenditure, he can disclose this thing.
But nobody will receive a bribe money and then the person will disclose.
And disclose it.
But,
Be sure.
but what I know is that
Oh, yeah.
even if,
At
even
best,
if the person,
it should be a gift, and then the gift tax might apply. I don't know.
but
No, but
what I know
he-
is that even
Mhm.
though he may not disclose it, when it comes to light, it will be taxed.
How should it be
When
taxed?
there's an investigation, that's when there's an investigation.
Yes, when it comes to light, that he received
An
such.
investigation takes a lot of years. So
But crime doesn't know time, they say.
yes,
If
but
it is
In
bribe,
the
if it
first
is
place,
bribe
it's a
money,
crime. So I don't know why you tax it.
you will
And
disclose
then
it in the first place.
not
what about
refundable.
prosecution? If it's a bribe and the person acknowledges it, it should be prosecuted. I don't know why the tax should be applied. I don't know.
Okay, this is your homework. Please go and find out. Illegal money should it be taxed? And look at it from embezzlement or bribe. By the way, would the person be asked to refund it if it is embezzlement? Is embezzlement the same as bribe?
No,
No.
Embezzlement, what is embezzlement?
embezzlement is misapplication or misuse or stealing from money that is in your custody. Whilst bribe is you paying for the wrong or you receiving for no work done.
Okay. All right. Cool. Let's continue. Now you come to F. It's a dividends of a company. So dividend is non-deductible because it is excluded expense. So when you're advising your client, tell him that, look, for interest, you can deduct it to reduce your profit, even though there's a 10 capitalization. But when it comes to dividend, you can't deduct dividends. Okay. That is the first one. The next one that you need to mention is the taxation of dividends. The returns that the shareholders get from investing in equity is dividend, and dividend is taxed at the rate of 8%, like we saw in the paragraph 8. Depending on the double taxation agreement between Ghana and the country, if they are non-residents, then their dividend to be subjected to the appropriate rates of dividends according to the double taxation agreement. So remember, Section 115 also imposes tax on dividends paid. But when you mention the dividend, I need you to also mention the exemption. Section 59(3). It says a dividend, this thing we looked at it the last time when we were looking at taxation of shareholders. A dividend paid to a resident company by another resident company is exempt from tax where the company that receives the dividend controls directly or indirectly at least 25% of the voting power of the company which paid the dividend. Somebody was supposed to do something for us on this particular thing. I've forgotten. That the person was supposed to check why 25% but not 10%. Okay. So please remember to also mention the taxation of dividend. Then, issue of shares. If I issue shares or if we float shares, does it have any tax implication? The question is no, because funds raised through the issue of shares is not treated as a taxable income. It's a capital. It is not a taxable income. It's not an income that you have received, the proceeds that you get. So even though when you are raising equity, financing, some money will come to your hand. That money, when it is from the consideration from the shares, there's no capital and there's no tax on it. But remember that there may be stamp duty of 1%. That when you go and issue the shares or you go and register, stamp duty will apply. It is not under the Income Tax Act, but it's something that you can chip in. You can put it in so that we know that indeed you are discussing things that you are very familiar with.
Hello, Council.
Yes, madam.
Your question was, you said issuing or what, floating of shares?
Yes, issuing shares. If you issue shares, does it have any tax implication? No. Assuming that I want to buy shares in your company, does it have any tax implication? No. Because the consideration is not an income.
Mm-hmm.
Do you get a point?
Yes, I want the second word you used. You said if you are issuing or
the flotation of shares. Float.
Yes.
If you are floating shares, flotation of shares. You are floating it. You are issuing shares to the people to come and buy, or shareholders to come and buy. Yes, that's what I meant.
Okay. All right. That one too, no tax implications.
Okay, let's look at retained earnings. Some of you indicated that retained earnings is a source of funding, isn't it? Retained earnings is a source of funding. Yes. So the first comment is that when it comes to retained earnings, there is no immediate tax implication. After all, you have paid the taxes. So the money in the retained earnings account, or they are post-tax, and therefore the business can use it and to not attract any tax. Okay, it is only when you are going to distribute or you are going to pay out that retained earnings, that is when dividends will come in, and therefore you will be required to pay dividend tax. Is that okay? The question is, if a company decides that we need more money, but we don't want to go and borrow, like the banks, the question that I mentioned, the banks the last time, they need money, they need to recapitalize. So if they are going to recapitalize and they need to take money from the retained earnings account, what is the tax implication? Section 59(5) says that a withholding tax of 8% will be applied because it is a capitalization of profit. We discussed this in the last time, and we said that there are a number of considerations that the Commissioner General will have to consider before giving a directive. Do you remember? Those of you who take note, do you remember?
Yes, sir.
Okay. All right. So a dividend is deemed to be paid to each shareholder of a company in proportion to the respective interests of the shareholder if the dividend consists of a profit which are capitalized. So remember to mention it also. Then, retained earnings can also have tax implications. You there, you think say you are not, you have
Hello,
the
Senior.
retained earnings. Yes, sir.
Please, if you could take the issue of capitalization again, if you can refresh my memory on that.
iPhone 3. What's your name? Please, you need to change it to your actual name. What's your name?
Bright. I often don't use this. Bright.
Right. Last week you weren't here.
Yes, please.
Okay. So last week we discussed that we were reading taxation of shareholders. And we are saying that sometimes the law says that if you pay dividend, you must withhold tax. But sometimes a particular company may decide not to pay dividend, but rather capitalize it. Right. Did you listen to the video I shared?
Not yet, sir.
Hey. Okay. So if they decide not to pay dividends and they want to transfer money from, or they want to transfer part of the retained earnings to stated capital, then we say they are capitalization of profits. So there will be a transfer from retained earnings to stated capital. When that happens, Section 59(5) says that it is considered as dividend paid. And therefore, if dividend has been paid, the Commissioner General will require or issue directive to the company to come and pay taxes on those dividends that has been capitalized. You need to go back and look at it carefully. We used the banks as an example. We said the banks, when they were moving from 120 million Ghana cedis stated capital, their capitalization, when the Bank of Ghana issued a directive, when they were moving from 120 million to 400 million, most of them said that they're not going to pay dividends. Rather, they're going to use part of the retained earnings to recapitalize their business so that they become more stronger. So that's what we said about capitalization. It has a tax implication. And the further implications are that if you have retained earnings and you always want to keep the retained earnings, the Commissioner General can deem it as undistributed profit. Again, this one too, we looked at it last week. Okay, undistributed profits. And the undistributed profit is where a company which is not controlled by more than 5 people and they associate, very close company, when they don't distribute a reasonable portion of their retained earnings, the Commissioner General can treat, through a notice, can treat part of the undistributed profit as dividend. And then he will give directive that the appropriate taxes should be paid on the dividends. In fact, this provision, we said that it is anti-avoidance provision. Some people would decide to retain profits indefinitely, like an indefinite retain profit. perpetuity, and then they have huge return earnings. Until they pay, the Commissioner General cannot come for dividend tax of 8%. And the reason why we said it's an anti-avoidance provision, anti-avoidance provision is that if the Commissioner General suspect that you are intentionally delaying the dividend payment and therefore the dividend tax, then he will use his powers to declare part of that return earnings as part of dividend. So you may think that you are using it to finance your business or whatever. If the Commissioner General considers all other factors, he will now go ahead and declare that a tax be paid on it. Okay, so you have to mention something like that. Any question? Then we move to leasing. Some companies can also be financed through leasing. Okay, leasing. We have finance lease and operating lease. Unfortunately, IFRS 16 has come to collapse everything. And under IFRS 16, we only have one lease, which we now call the right of use of assets. So the assets will be made available to you, and then the lease obligation is created. Those of you who are accountants. So there's right of use. IFRS 16, that is International Financial Reporting Standard 16, says there is a right of use asset, and then there's a lease obligation. That new distinction that IFRS 16 adopted, for we tax people there, will continue to remain our finance lease and operating lease. Okay. So we have to now go ahead and distinguish between the two. What is a finance lease and what is an operating lease? A finance lease looks more like you have acquired the asset using a loan. Yes, that you'll be paying it over small. So mostly your repayment includes the capital portion and then the interest portion. Loosely, you can describe it as like a high purchase, like work and pay. You see that at the end of the period, the guy will pay off and then take the assets. Same thing happens to finance lease. So finance lease, we treat it as a sale of assets, or you are acquiring an asset. The lessor is the person, the owner. The lessor is the owner. And then the lessee is the borrower of the asset. So the lessor will sell the asset to you, he'll realize the income, but of course you are going to pay it over time. So you are the lessee. To you are buying a fixed asset. Okay. And so Section 30 provides for annuities, installment, sales, and finance leases. Section 31 says, in calculating the income of a person, any payment made by that person under a finance lease or in acquiring an asset under an installment sale shall be treated as interest and repayment of capital under a loan made by the lessor or seller to the lessee or buyer. So the lessee is more like the buyer, and then the lessor is what? The seller. What I need you to know under Section 30 is what is a finance lease. Any other thing which is not a finance lease is an operating lease. And let me explain what we mean by an operating lease. Operating lease simply means, or more like you are renting the thing. You have leased the thing. Okay. You have leased the thing. And so that becomes an operating lease. You pay rental. Dominic, let's hear you. Dominic.
Yes, sir. Yeah, my issue is on the retained earning.
So we should go
There
back
was an issue, yes, a practical issue. I don't know what you say about this. There is a company that has been audited by GRA and was made to pay tax on dividend. It was a free zone company and was made to pay tax. That was, the tax ended at the 2019 year of assessment. After that, from 2019 up to 2023, a company that was consistently declaring dividend every year had not declared any dividend again since 2019 year of assessment.
Okay.
And what they are doing is that they are rather veering into other activities, like for instance, it is a let's say what do we call it, a sawmill or a company that deals in mailing of goods and exporting.
Mm-hmm.
And then it started growing trees for as raw materials for the mailing sawmill,
Mm-hmm.
opening radio stations, TV stations from the retained earning that they were supposed to have distributed to
Are
the
they
shareholders.
a different company or is the same company?
It is like a subsidiary kind of, because it is being financed wholly by this free zone company.
They can do that. Or
And so isn't it an anti-avoidance scheme?
no. So you have a point there. But if you look at section 59, it says that the only way we can consider it as an anti-avoidance is when the company is controlled by no more than 5 people. The question is how many shareholders or how many people control the company? Now, let's go at 59.8. Read 59.8 for me, listen. Can you see my screen?
Yes, please.
Read 59.8. Mm-hmm.
Where the Commissioner General is satisfied that a company controlled by not more than 5 persons and their associates does not distribute to its shareholders as dividend a reasonable part of the income of the company from all sources for the basis period within a reasonable time after the end of the basis period, the Commissioner General may by notice in writing treat as dividend the part of the income of that company that the Commissioner General determines to be dividends paid to its shareholders during the period or any other period.
Good. So you see, if they fail to distribute, so like you mentioned, for almost every year they were, then all of a sudden they stop. And they are building up accumulated profit or retained earnings. The Commissioner General can invoke his power under 59.8 and declare for them. If you are failing to declare, I'm going to declare for you. And when I declare that one, then I'll take my withholding tax. That's what the Commissioner General will do. But
Yes,
the fact that they are not distributing dividend does not mean that it is deliberate or they are engaging in tax avoidance. No, there could be genuine reasons why they are doing that. And read the 58.9 for 59.9 for me. Let's read the 9 and listen.
the Commissioner General shall, in determining whether a company has distributed a reasonable part of its income from all sources for a basis period, consider A, the current requirement of the business of the company after accounting for any adjustment which the Commissioner General may make under Section 31 and paragraph 53 of the 7th schedule.
Okay, so the
B,
question is, what is the current requirement of the business? Do they need money to operate?
so say, for this one, they need money for the growing of the trees. That is directly related. But where you are using the money to open radio stations, television stations, and other things, they are not related to the business you are doing.
Yeah, but it is the same company, the same group. And you think that it's a different company?
So sir, my question I asked them was, there is a shareholder, the majority shareholder is not a Ghanaian, and is not a resident person in Ghana. So my question to them was, how are you satisfying the requirement of that shareholder? Is he the one who, and the other companies are not making profits? They are not making profits. So where is the interest of the?
Wait, if the company A, which is the main company, has made a profit of, let's say, 100 million, how are they able to use that money to finance a different company?
Okay, so what they are doing is that they are just doing a current account for those two other subsidiaries, or let's say, the subsidiaries,
So it's a
and
loan.
paying they don't treat it as a loan.
Why?
They are just financing all their activities and bringing their balances into the final account.
So is it not intercompany loan?
They don't treat it as a loan.
They treat it as current account.
Current account. And so it is the final balance of those companies that is transferred into the main account for the company itself.
Then whoever is doing the audit should go. Maybe you can look at it from a transfer pricing point of view. You can't give money to somebody free of charge like that. So it's either they are giving the money to them to they are pre-financing their activities, and therefore some interest amount should be charged on it from transfer pricing point of view. And if they are charging some level of interest, then that should be okay. Because if they were not related, assuming they were not part of the group, would they have given that money to them free of charge? No. So if you are a tax auditor, you should be looking at the current account as either a loan. In fact, if you look at the transfer pricing regulations, I think regulations 9, if you give money to your sister company or your related party, and it is more than 12 months repayment period, it is treated as a loan. And the Commissioner General can impute an interest on it. The Commissioner General can even say that I am imposing a treasury rate, because if they had borrowed this money, this is how much the company would have paid. So I won't allow you to give money to them free of charge like that. See? So 9 says that,
Yes, sir.
9 says that the Commissioner General, before he considered that dividend as reasonable, should consider the current requirement and also any other requirement necessary for the maintenance and development of the business in question. So I agree with you that unless it is part of the company, then maybe the radio station is part of the existing company, the timber is part of so at the end of the day, it's the same company doing all these things. Then you can say that they want to expand the business and therefore they are investing in it. So if a Commissioner General raises any assessment on them, they can use that one as a basis for challenging the Commissioner General's assessment. But if it's a separate company altogether, and they are treating it as current account, then I will see that one as a loan, is as an intercompany loan. And if they're not charging anything on it, I will go after those intercompany loans and then slap interest on it. But the law allows the company to keep retained earnings, and at the end of the day, if it is a business requirement to maintain the business, that should be allowed.
All right.
Okay. I thought I was going to finish this thing, but it looks like I have 20 more minutes. Okay. So undistributed profit, we've mentioned it, that they do that to avoid tax. However, we have a good anti-avoidance provision that the Commissioner General can look at. We were discussing leasing, and leasing, which I mentioned that in accounting, we will lump everything together and call it lease. IFRS 16 puts everything together as lease, but in taxation, we continue to distinguish between finance lease and operating lease. Finance lease is treated as either acquiring an asset or selling an asset. You are incurring a capital expenditure. But when it comes to operating lease, we are looking at more of a rental in nature. And so section 30, the definition, subsection 4 says finance lease. And please listen to the definition very well. If the thing is not a finance lease, then it's an operating lease. So section 30 subsection 4 says finance lease means a lease agreement that provides for the transfer of ownership at the end of the lease term, or where the lessee, that's the buyer, has an option to acquire the asset for a fixed or presupposed price after the expiry of the lease term. So any arrangement where the lessor is likely to transfer the ownership of the asset to the lessee, then we say it's a finance lease. It is more like you have bought it, but you are paying it in installment. Those of you who rent photocopy machines, you see, you can either lease it for a short term, but if the agreement is like that the transfer will occur to you, then at the end of the day, you will have to conclude that it's a finance lease. And like I mentioned earlier, finance lease is more like an acquisition of an asset. Anything which is not a finance lease is an operating lease. That's the A. B says a lease agreement in which the lease term exceeds 75% of the useful life of the asset. That means that it is more of a long term. In other words, if the transaction is like let's say 4 years, if the asset is like 4 years, the lease term is about 3 years. This one you can't call it you can't call it an operating lease. 75% is a significant useful life. Okay, so that will qualify as what? A finance lease. C says a lease agreement in which the estimated market value of the asset after expiry of the lease term is less than 20% of the market value of that lease agreement at the start of the lease. More or less, 80% of the value is gone. That should be described as what? A finance lease. In the case of the lease that commences before the 25% of the useful life of the asset, the present value of the minimum lease payment equals or exceeds 90% of the market value of the asset at the start of the lease term, or a lease agreement in which the lease is custom made for the lessee, and after expiry of the lease term, the assets will not be of practical use to any person other than the lessee. All of these things, when we see these features in the lease agreement, then we'll describe it as what? A finance lease. Operating lease is more like an expenditure, like rental. Okay, 1 year rent, short-term rent. So you hand it over very soon. There's nothing like 75% of the useful life, or there's nothing like that is custom made. If it is custom made, it is you alone that was made for. Nobody will want to use it after the lease term. So these two distinctions are very important, and we have agreed that, or you finance or accounting people have agreed that it is a source of finance to a business. The question is, what is the tax implication? When it comes to finance lease, this is what the regulation 17, the income tax regulation, treats. I hope I'm online.
Yes, sir, you are.
Yeah, you're online.
Okay. Sometimes when people are quiet. Ruth, today you are too quiet. Please read it for me. Ruth,
Hello, sir.
read it for me.
Final lease versus operating lease tax treatment.
Mm-hmm.
Final lease. Where an
Finance.
asset
Finance.
finance lease.
Mm-hmm.
Finance lease. Finance lease, where an asset has been leased for a leaser to a lessee under a finance lease. A, the lessee shall I deduct the interest portion payable for each year of the assessment as an expense from income. II, treat the repayment of the capital as a repayment under a loan agreement and shall not deduct that repayment from the income when ascertaining the income of the lessee.
So these are the first. If you are the lessee, you are the one who is going to lease the asset. You are the user of the asset. We are saying that normally when it is a finance lease, I have mentioned to you that for operating lease, it is a rental, so you are entitled to the deduction. Like you go to rent a car and then you go and pick one of their cars, you use it for 1 month. When you are returning the car, you are supposed to pay the renter, pay to them, and then you go. This is a genuine expenses, provided the renter was using the production of the income, that's fine. Will allow you to deduct. But when it's a finance lease, something like an asset where the likelihood of the asset being transferred to you is high because about 75% or it is custom made. Look at all the conditions that defines a finance lease. If you are the lessee in a finance lease, we are saying that the payment that you are going to make, it has two components. We have the interest component and then what? The capital component, just like installment payment. So when you are paying installment, there's the interest portion and then there's capital portion. Or those of you who have taken bank loan, normally when you are making the payment, there's the interest portion and then there's the capital portion. So regulation 17 is saying that the lessee, you have to deduct the interest portion as an expense, but the capital portion, you cannot deduct it because the capital is a loan repayment. Then I says be entitled to capital allowance in respect of the capital portion. And you will start dealing with advanced taxation when you start with capital allowance. So any finance lease, the capital portion is treated as a capital expenditure, and therefore will grant you capital allowance on the capital portion. Please, are we on the same page?
Please come again.
That's the danger. That's why I like calling people. Some people, Mr. Kwame, are you with me?
I'm here, sir.
Did you follow what I said? Or you didn't hear?
I did, but like Geoffrey, you said the capital side should be capitalized. The capital side of the operation should be capitalized, if that's what I heard the last one. Yeah. Yeah.
Okay, Kevin, are you with me? Kevin Oblite. Your name is nice, oh. Kevin.
Oblite is for the family of the Kwame, so.
Oh, really?
Yes, sir. Yes, sir.
Okay.
It's
All
Oblite Kwame.
All right. Are you with me?
Yes, please, I'm with you.
Okay. What about Joshua? Joshua, are you here?
Yes, I'm here. I'm here, yeah.
Okay. Jones, read for me. Mr.
All
Jones.
right.
17. Read regulation 17 for me.
17.1. Where an asset has been leased by a lessor to a lessee under a finance lease, A, the lessee shall deduct the interest portion payable for each year of assessment as an expense on income. Treat the repayment of the capital as a repayment under a loan agreement and shall not deduct that repayment from income when ascertaining the income of the lessee.
Do you agree? Simply because you are the lessee, you are the user of the asset, or you came to buy the asset from me. I'm the lessor. I'm the owner. So you bought an asset under a finance lease. When you are going to do the installment payments, the money is split into two. We have the capital portion and then the interest portion. What regulation 17 is saying is that treat the interest portion as an expense and deduct it from your income statement. It's an expense. But the capital portion cannot be deducted because it's a capital. Then I says you will be entitled to capital allowance on the capital portion. Do you see the point? Jones?
Please. Yes, please.
Okay. So when you start dealing with capital allowance, advanced taxation, they will teach you about how the capital portion will be capitalized and then capital allowance is granted. Then in terms of IV says in respect of a lease of a road vehicle other than a commercial vehicle, the capital portion shall not exceed the amount mentioned in subparagraph 4, which is 75,000. When you are dealing with capital allowance, you work more of them. But what I want you to understand, the implication. If I ask you a question, I want to go and lease an asset under a finance lease because I don't have money to finance it. What is the tax implication from strategic tax planning point of view? You're supposed to advise me on these things. Tell me that, oh yeah, the interest can be deducted, but the capital portion, you have to capitalize it. And then if it's a vehicle, the amount cannot be more than 75%, 75,000 cedis. Okay. Let's look at the lessor. If you are the lessor.
Hello, sir.
Yeah.
With the finance lease, the lessee has an option to exercise at the end of the period, whether to take over the asset or not to take over the asset.
Yes.
So if the lessee decides not to exercise the option to take over the asset, the tax implications, what happens?
It still doesn't change the fact that it is a finance lease. We will look at the term. We look at the agreement. Okay. If the agreement says that you can take it, it's the lease agreement that provides for a transfer of ownership. So if the agreement does not provide transfer of ownership to you, then it's not a finance lease. Do you understand?
Yes.
From the beginning, we know whether it's a finance lease or operating lease. It's not like when we get to the middle, then we determine whether it's a finance lease or not. No. And again, we are saying that granted the agreement does not even transfer ownership, does the lease term exceed 75% of the useful life? You can't tell me that you are leasing an asset and the period is 3 years when the useful life of the asset is 4 years. 1 year now, who come and use it anyway? Who will even want to use it? Because that time when the asset is almost one apart. Don't you agree?
I agree.
So the terms of the lease will tell us what it is. And immediately these terms are available, we will go ahead and apply the law. We are saying that for a finance lease, we have determined it from day one, before the lease agreement is even signed. From day one, we know it's a finance lease. If it's a finance lease, you are going to make repayment. The interest portion, please treat it as an expense. The capital portion, you cannot treat it. However, we'll give you capital allowance on that. And if it is a vehicle, we'll limit you the capital allowance threshold of 75,000 for vehicle. Case closed. You get a point?
Yeah. Yes, please. It's clear.
Okay.
Yes, sir. Well explained. Well explained, sir.
Okay. Now let's look at the lessor. The lessor is the guy selling. He's the guy selling. And for the lessor shall, in ascertaining the income of the lessor for a year of assessment, include the whole amount of the interest and repayment of the capital for that year as income, because you are selling. And we normally see you as, take it like you are a car dealer. Okay? And you are selling. You sold this thing to this guy on credit. And he's going to pay in installment. So for you, the repayment and the interest is your income. And therefore, we have to treat you as such. And IIS is not entitled to capital allowance because the asset is not for you. All right. Let's go to sale and lease back. I have 5 more minutes. Let me see. Oh, I can't finish. Okay, I'll rush you. Then I'll send you the video. I'll rush you. Sale and lease back. You know, some companies can do sale and lease back. I remember in 2011, MTN did the same thing. They sold some few properties and then leased them back. Okay, so when you sell, okay, when you sell, we are likely to calculate capital gains tax on it for you. When you lease it back, then we have to apply the leases to you as well. Okay. I think that's the simplest, that's the simple, what do you call it? Explanation that I will give here.
Timore, please
Yes.
take it again. When you sell, capital
When you
gains tax is calculated.
Of course. So assuming
on-
that you have a building and then you do sell and lease back. Mami, do you agree that you may own a building, but you can do sale and lease back?
Yes, you can sell it and then you can lease it for a long period, like 10 years.
Correct. So if you sell it, we assume that you have realized the asset. And if it is a capital asset, then we'll have to come for capital gains from you. Realization, section 38. Over section 35 even talks about it. Calculation of gains and losses. A gain made by a person from the realization of an asset or liability is the amount by which the consideration received exceeds like that, the cost.
The cost of the asset.
When you sell it, you have realized it. And realization means you have parted ownership with it. Section 38. So if it's a land or if a building, it will come after you, capital gains. So if you're advising your bosses about a potential sale and lease back, think about the tax implication of the realization. When you realize it and you come back and lease it back, then we now have to come and consider maybe it's an operating lease. So we'll allow you the normal, deductions as we have discussed under leasing. Okay. Mami, are you okay?
Yes, sir. Thank you very much. I was just making the notes. Thanks.
Okay. Let's look at grants, gifts, and incentives. Grants, if you receive grants, it's likely to be taxable unless it is exempt. Assume that Mami Limited has received a grant. We can see it as a gift, can see it as a donation. As far as it is received in respect of your business, we cannot allow that grant to go scot-free, isn't it? Potentially, we have to tax it unless it is exempt under the law. Okay. Now, if the grant comes in the form of capital allowance, in the form of an asset, then likely we may grant you capital allowance on it. Let me ask a question. If you go to your office and you find money in front of your office, will you want us to tax it? Will you consider it as a gift? Look at section 5. Income from business. The income of a person for a year from a business for a year of assessment is the gains and profits of that person from that business for the year or part of that year. A person who is ascertaining the profits and gains of that person or of another person from a business for a year of assessment shall include in the calculation an amount specified in respect of services, consideration received in respect of trading stock, gains from the realization of capital asset, amount. Let me go to look at V. A gift received by the person in respect of the business. And VII says, and an amount derived that is effectively connected with the business. And that would otherwise be included in calculating the income of that person from an investment. So any income you receive that is connected to the business, we'll consider it as what? A business income, and we'll tax you unless that income is exempt from tax. So ladies and gentlemen, we'll end here. In fact, that is the end. So normally we examine most of the past questions. You will see either debt and equity. If you go to the exam so and you meet other types of financing, you should be able to discuss them. Especially limit yourself to the income tax portion. Some of them may have VAT implications, but clearly advise on the income tax portion, and then you'll be fine with it. Thank you very much. So we'll see you next week.